020 versus 248. Two AI stocks, same market, completely different positioning. But here's the catch. One is tied to global data and policy intelligence. The other is tied to AI-powered commerce and real-time transactions. So why are both still this cheap? And more importantly, which one does the market reprice first? AI isn't just about chatbots anymore. It's becoming infrastructure, from enterprise systems to government intelligence to digital commerce layers. And as this expansion accelerates, markets behave in a very predictable way. The biggest, most obvious companies get priced in first, but the deeper layers, they often get ignored. This is where pricing inefficiencies usually exist. This is the type of layer institutions quietly watch, long before broader attention shows up. Now, this doesn't guarantee anything, but it explains why this part of the market matters. Because if AI continues expanding into real-world systems, these supporting layers become critical. And this is exactly where smaller cap opportunities tend to form. Think about one of the most complex problems in AI, not building models, but understanding massive, constantly changing data environments, especially in areas like government policy, regulation, and global decision-making. Because here's the reality. AI isn't just about generating answers. It's about processing structured and unstructured data at scale. But here's the catch. Most companies don't operate in this space because it's messy, fragmented, and difficult to standardize. Now, this is where things get interesting. Some platforms are designed specifically to organize, analyze, and deliver insights from this type of data. And the second company we'll cover? It operates in a completely different layer of AI, which makes this comparison even more important. This fits into the AI-driven data intelligence and policy layer, and that matters more than it seems. Because if AI expands deeper into enterprise and government systems, then structured intelligence platforms become essential. If this layer expands, companies like this become critical, and this is the part most people miss. This is exactly where institutions start tracking early signals. Looking at the stock, it traded significantly higher in previous cycles, then saw a major decline as small cap sentiment weakened. Now it sits around $0.20 per share, so the question becomes, is this just a broken stock or something the market hasn't fully reevaluated yet? The company focuses on AI-powered data intelligence platforms, helping organizations track policy, regulation, and global developments. This includes analytics tools, data feeds, and decision support systems. Not flashy, but deeply integrated into information workflows. And this is where things shift. Because when you actually look at the company behind this, you're looking at Fiscal Note Holdings Inc., ticker note, trading around $0.20 per share. So why is it still this cheap? Because scaling this type of platform takes time. Revenue growth, adoption, and execution all matter. The market often waits for proof before repricing. This doesn't mean it moves tomorrow. There are risks here. Timing is the key factor. Now, before we get into the second stock, here's something most people completely overlook. Even though AI demand is expanding rapidly, some companies tied to real-world systems see delayed price reactions. The technology evolves first. The stock follows later, and that gap is where opportunities sometimes exist. But unlike the first company, which operates in data intelligence and policy systems, this one sits directly inside AI-driven commerce and customer interaction, where the focus isn't data analysis, it's real-time engagement and transactions. And this is where it gets interesting. Because this is the layer consumers actually see. This company focuses on AI-powered commerce platforms, helping businesses interact with customers using automation and intelligent systems. Think personalized experiences, real-time recommendations, and AI-driven purchasing flows. This is where AI meets revenue. If AI adoption continues across digital platforms, then companies enabling smarter commerce experiences naturally become more relevant. Because AI isn't just about intelligence, it's about application and monetization. Looking at the stock, it previously traded at higher levels, then corrected along with broader tech markets. Now it sits around $2.48 per share. So again, the setup becomes clear. Past momentum, pullback, stabilization. Now the question becomes, does growth return? This is where it gets interesting, because the company behind this model is Resolve AI PLC, ticker RZLV, trading near $2.48 per share. So why hasn't it moved? Because adoption, scaling, and competition all matter. Execution is everything in this space. This doesn't guarantee anything, and there are real risks here. Now, here's where it gets interesting. You're looking at two completely different AI plays. One is data intelligence and policy infrastructure. The other is commerce and real-time application. So which one moves first? If AI expands deeper into institutional and government systems, then data intelligence platforms could benefit earlier. But if AI adoption accelerates in consumer-facing environments, then commerce platforms may move faster. Then there's risk. One depends on structured adoption and contracts. The other depends on scaling and competition. And price-wise, there's a massive gap. But that doesn't automatically mean value. Zooming out, both of these companies sit in parts of the AI ecosystem that aren't fully priced in. Not because they don't matter, but because they're not obvious. And this is the layer that tends to move later, but often more aggressively. This is where institutions look for inefficiencies. This is where market gaps exist, and this is where positioning matters more than hype. If you're tracking where AI is actually expanding, not just where attention is, these are the types of setups worth keeping on your radar.